Well, the quarter was dominated by Trump. Trump got the news, Trump got the headlines, and apparently Trump led the rally in equity markets. We feel that there's been two more fundamental changes in the end of 2016, particularly quarter four, and there's been the start of the bond market normalizing back towards higher bond yields, and oil and commodity prices normalizing back to long-term levels after a very extreme fall in the first half of 2016. Those really pushed most multi-asset portfolios in terms of the focus on currencies, asset classes and countries, more than the simple Trump story. I'm sure Trump was important. The idea of further economic growth, particularly in the US, is behind lots of the headlines, but we really feel that the fundamentals have changed materially as led by oil, inflation and bond markets. Well, in a very volatile year, active management at both stock selection and asset allocation level have tended to produce good returns. The difference between though high growth portfolios, mainly equity focused, and more defensive portfolios, more fixed income focused, is quite stark. Higher growth portfolios have continued to have a double-digit year at a time when expectations were much lower. Defensive portfolios, those sort of invested in fixed income, have had a lower returning year, but the difference between the first half and second half was very different. In the fourth quarter of 2016, we saw bond portfolios and defensive multi-asset portfolios fall in value, probably for the first time since prior to the 2008 GFC. Now, investors should not be worried by this. Bond portfolios have produced very strong returns in the last 5 to 7 years, and we have been positioned carefully to minimize loss or drawdown in that environment. But it is the case that bond portfolios sometimes do lose money, and quarter four was an example of this. Yeah, with long-term valuation-driven investors, we always look for kind of areas that the market is not focusing on. And even prior to the Trump election win, we were thinking that, you know, a low inflationary world forever was not likely to be the case going forward. So we were increasing the amount of assets in our portfolios that were able to resist falling if inflation were to increase. Inflation-linked bonds, commodities and certain currencies do very well in that environment. So when post-Trump and the Trump election win, expectations of inflation, particularly in the US, have risen, then those parts of the portfolio have performed very well for our investors. What am I looking out for? I'm looking out for the reality of those expectations, the increases in oil, the changes in currencies influencing import costs, actually leading through to both cost inflation and wage inflation. As yet, it's still very kind of early stages in the US, and in areas like Europe and Japan, it still remains a low inflation number print. So in 2017, I expect those numbers to change, and really it's about what is the market pricing in versus the reality. We expect that the US Federal Reserve are going to be looking at that very closely, and my bet would currently be on inflation in the US rising much more rapidly than currently the market is expecting.